For more on this, let's bring in Lou Basenese, Fox Business contributor, and EJ Antoni, Heritage Foundation chief economist. Great to see both of you. So, EJ, PCE came in at 3.7%. The core, by the way, the PCE core, that's really what the Fed looks at. That was 3.3%. That's pretty far above their 2% target. And it does seem now like the oil prices, which so far were contained in the energy sector, are spilling outside of that core, no?
I think so, David. I think that's a really good assessment. And I think it's something that's likely going to continue, in part because of what's going on with diesel. We talk a lot about gasoline prices, and rightly so, because that's what hits the consumer in the face every week, right, when they go to fill up at the pump. But the economy really, truly does run on diesel. And if we look at what's going on with refiners and crack spreads right now and how much refining capacity has been taken offline in places around the world, especially Russia, California, a little closer to home, whatever the case, the fact is diesel prices are likely going to stay high despite a Strait of Hormuz reopening whenever that comes. And that means that you're going to continue to have those higher costs trickle down throughout the entire economy. That's going to obviously continue to put upward pressure on these different price indices. I will say, however, I think part of what we saw in this latest report just has to do, once again, with something that the Bureau of Economic Analysis really needs to take another look at. I know they will eventually, which is portfolio management costs. And the fact is that depending on how the market's doing, that has just really an overweighted effect in terms of what happens with the inflation metrics. So
explain how, EJ, if you can, in simple language, explain how it has that effect.
Well, if you have a product, David, a financial product where a fee is going to be charged based on how much the market goes up, in other words, the more the market goes up, the more you have to pay in fees. Well, if the market has a great quarter, then all of a sudden you're going to see an uptick in that inflation metric. And if you're putting too much weight on that component on top of it, you're going to have these artificial swings to the upside. I'm not saying we don't have an inflation story here. We do. It's largely energy driven. But I think that is just kind of a bit of a fluke in this one report.
Okay. Another way, Lou, that I don't think it is inflation driven is the economy itself. Some people, you're beginning to hear these phrases that inflation is higher because the economy is running too hot.
Yeah, right.
That old phrase, and that harkens back to the Phillips curve, where people think, inflation comes from economies, or one of the sources of inflation is if there's too much economic activity. Right. That was disproven going way back to the Reagan administration, even before that with JFK in the early 1960s. But the point is, you're hearing that. Kevin Warsh doesn't believe in the Phillips curve, and to the effect that all of this affects decisions he makes. If he sees that connection, the fact that the economy is running hot and you have inflation, he's not going to look for the hot economy as the source of inflation. He's going to be looking for something else.
No, absolutely. And I think, look, David, you gave us a great history lesson on the Phillips curve and who believes in it, who doesn't. To EJ's point, I think this number convinces me that the Fed is stuck on pause, because if 3.3% is the core and you've got a little bit of an arbitrary bump for financial services, that labor market print last month of 23,000 jobs lost means you can't even think about hiking rates in this environment. And more to the point, Kevin Warsh said, I'm not going to tell you what I'm going to do. I'm not going to give you forward guidance. I'm going to be data dependent, truly, maybe have less meetings and really focus on the data. So I don't know why Jackson Hole is topping the headlines, because I believe it's going to be much ado about nothing. Investors want it to mean something, but the data is telling us right now the Fed's not going anywhere with rates anytime soon.
EJ, were you pulling your hair out as I was listening to this talk about the economy's too hot and that's why you have inflation?
Yeah, as you and Lou were just saying, look, the fact of the matter is economic growth does not cause inflation. It's exactly the opposite. Growth is inherently deflationary. Why? Because you're increasing the number of products and services that are available to buy with the existing amount of money. In other words, you're going to increase the demand for money, not just increase the supply of money. So again, it's inherently deflationary. It's part of the reason why the AI boom and the productivity boom, again, that's deflationary, because you are pushing out that production possibilities frontier, as we like to say in economics. So no, the Phillips curve has been disproven time and time again.
And we do have productivity increases, and that's one thing that most economists do agree on, is the more productivity you have, that's a downward move on inflation as well.
And more to come with AI. I mean, Kevin Warsh believes
well, it's
that,
already
too.
beginning to
It's
come
showing.
with AI. I mean, it makes a lot of people's jobs easier, quicker to do, et cetera, which means you can produce more of whatever you're trying to produce. But Lou, you do have this $40 trillion debt that we now have, and you know there are cases to be made on how that specifically could infect our economy and affect inflation.
Well,
what do you think?
Look, the Treasury yields are creeping higher. That gets everyone a little bit scared, and rightfully so, because interest expenses are going to go up. I think it's a little Pollyannish to think we can just outgrow this. We have to outgrow it, but then also cut spending in somewhere or hold back spending so we can actually catch up to it. The sad thing is, and I'm curious what EJ thinks too on this, is like, I don't believe that Washington, absent a crisis, will really rein in spending. And it's an unfortunate thing. We need a Wall Street crisis to force K Street to actually do something on the spending side.
Well, so what do you think, EJ? The debt and bond rates, first of all, what's the connection, if at all?
Well, I think it's a very clear connection. And Lou's absolutely right. I don't think there's any kind of political will here in Washington to actually cut spending absent that crisis. And look, you can cut spending today, or you will be forced to cut it in the future because of the bond vigilantes. And there's your connection, right? If you allow essentially the government to just borrow ad nauseum, eventually the bond vigilantes are going to say, we don't want a repeat of what we just lived through the last 5 or 6 years, which was an implicit default. When you have the dollar lose, what, 20% of its value in only 4 years, essentially, you are going to pay back those bondholders with devalued dollars. It's the equivalent of defaulting on 1/5 of the bonds that you actually owe. And so as soon as investors start to sniff out that they think that's going to happen again, it does not have to be an explicit default, just an implicit default. That is enough to drive those bond yields higher.
All right, let's get out of economic theory, get into some specifics about what's happening with specific stocks. And let's start with Meta, Lou.
Yes.
We had that decision, $16.8 billion decision. Of course, that's kind of small potatoes compared to the tobacco decision, but it clearly, in pre-market activity, the market, it was up 4%. It ended the day up, but a lot less than 4%, up about 1%. What do you think? How is this decision going to affect the stock?
Not surprised whatsoever about this. I don't think it changes anything for the stock. It's been tremendously undervalued, but this is a stock I never have owned and will never own because they put principles over profits. This is a classic Wall Street admission of no wrongdoing, but pay a fine. And oh, by the way, now Meta's going to alter its platform and its app. Well, then I thought you weren't doing anything wrong. So I think they saw the tea leaves. They knew in discovery they were actually going to have to reveal a lot of information about what they knew. And I think the legal case that had merit was on the privacy violations, which has been a recurring theme for Meta from the Cambridge Analytica crisis and countless other instances. So look, I'm not a buyer. I think in this market, I'd rather put my capital in high growth, cheap names that don't have these potential liabilities that are hanging out there. There will be more to come.
Well, EJ, it sounds like a lot of money. It is $16.8 billion. Of course, Meta has a cash balance of about $90 billion. And so compared to what they have in hand in cash, it's not that much. But you know how these class action suits go. There are 29 states that are in which money's going to be spread around. There are 21 states remaining who are saying, I want a piece of that action. Couldn't it spread further than this?
David, I think that's perfectly reasonable. And in addition to all the great points that Lou was making, you know, one of the things that I'm not too thrilled about here is how much of this money is basically just going to go to government. And you know what? It's a matter of, yes, it is a lot of money, David, you're absolutely right, but put that money in the hands of government, which can never allocate even a dime efficiently. And you know a lot of this, unfortunately, is just going to get wasted, which is a shame, because clearly I think people have been harmed. And it is right, it's only just to actually make those people whole. And unfortunately, I'm not sure that this is actually going to be the best way to make that happen.
Okay. Very quickly, we don't have all the numbers in, but Nvidia's coming in. Lou, are you taking bets on Nvidia? It's supposed to have earnings of $2.10 per share, revenue of $92.17 billion.
I'm a shareholder, admittedly late to the profit party here, but look, they're growing revenue roughly 100%, earnings 100%. More importantly, that growth has been accelerating for the last 4 quarters. I think, though, this is one of those stories of good to great, and then the expectations have just gotten so far ahead of it. So I don't think the rest of the bull market rides on Nvidia, but I do think it's an important read. Do they guide for that continued growth of 90% plus, which would require $105 billion worth of revenue for Q3, which is 4 times as much as they reported in the entire year when ChatGPT launched. So this is the biggest growth trend we've ever seen in tech history.
Gentlemen, great stuff. We span the waterfront here today. I appreciate you being here. Lou Basenese and EJ Antoni, thanks a lot.